This session is sponsored and programmed by T. Rowe Price.
Hi, I'm Caroline Woods, and I'm here with T. Rowe Price portfolio managers Andrew Jacobs Van Merlin and Wyatt Lee. We're going to be talking about target date solutions today, both benefits and considerations when recommending this investment tool to clients. Wyatt and Andrew, so great to have you both here. Wyatt, we'll start with you. Let's talk about how the pandemic influenced investors' thinking about the markets, their portfolios, and ultimately retirement priorities.
Yeah. Great. Well, first, thanks for having us today, Caroline. I think this is a great question to start with. Obviously, the pandemic has been top of mind for all of us for more than a year now. From my perspective, one of the really pieces of positive news is that in many ways, the pandemic didn't influence investors' thinking. Seems to be a lot of conventional wisdom in the marketplace that when we hit a patch of volatility, like say what we saw in the early stages of the pandemic, investors tend to panic and abandon their investment strategy. However, from what we've seen over time, this really isn't accurate. Participants in DC plans don't react often, and they didn't react during the pandemic. In general, retirement savers tend not to trade very often. And more importantly, is that target date investors move even less. For example, only about 1.5% of participants made a trade during the first quarter of 2020. This is critical to the success of the defined contribution market and to target date solutions, because if participants tend to stay invested, they won't get hurt by falling into that trap of trying to time the market.
What about you, Andrew? Did you see any impact?
You know, I just think it's important to remember that for many defined contribution plan participants, the concept of risk has been a bit abstract, right? So we've been in a prolonged bull market. We've only had 10 bear markets since 1950. But on the flip side, this is the second one they've experienced in the last 3 years. So I think clearly investors have a newfound appreciation for risk. But at the same time, if you think about the characteristics of the recent bear markets, they've been very short with these really sharp recoveries. So again, I think it kind of comes back to the point that Wyatt was making. I think it's an important reminder that investors need to stay focused on their long-term objectives, and also reminders to avoid making rash decisions when markets get bumpy.
Wyatt, let's talk about those who actually choose their own investments. How has their mindset shifted? Are they thinking about different options now then?
I think this is really a good place to build on Andrew's point about risk. The big mindset shift that I've seen, especially with plan sponsors, is a much more holistic focus and evaluation of risks that plan participants face. Andrew talked about that short-term risk, but really they're starting to focus more broadly on the range of risks. And there's been an evolution here. When I started working in target date strategies, the first question that came out of the mouth was, what is a target date strategy? That moved to, I need a target date strategy. Now there's a lot more focus on what kind of target date strategy is needed. And then as they're going through to try to answer that question, plan sponsors are moving beyond that focus on short-term risk and thinking about all the needs that their participants have. Longevity, inflation, volatility, behavioral. And then they're trying to prioritize these risks based on what they're trying to achieve. And ultimately that gets them to a better match in terms of what they want for the plan and what their target date fund is going to deliver.
So Andrew, building on that, what are the benefits of target date investment solutions, and then what are the challenges?
Well, I think it's a combination. I think first and foremost, it's the simplicity to the end investor. But you have the added benefit that there's a sophisticated, professionally managed portfolio underneath the hood. You know, if you think about the driving forces in a successful retirement, they're always changing. So I think it's important to have a partner with a deep understanding of kind of how markets evolved, participant demographics, importantly for retirement saving, but also investor behavioral aspects. And to that end, I think target dates have broadly delivered, especially on the accumulation part of the journey. But in the last 2 decades, with the adoption of target date, a lot of target date investors are nearing retirement. And I think if you think about the decumulation side of the journey, that's an area where it's a bit more been a bit more difficult for the industry to find a single sweet spot.
So Wyatt, in terms of client needs, what's shifted in the way people access their retirement investments, either at retirement or throughout? And what's really kind of sparked that adjustment in thinking?
Yeah. There is a shift happening, and it's kind of ongoing right now. There had been a long trend of many investors simply taking their money out of their plan near the point of retirement. But we're increasingly seeing participants stay in plan longer. And using the benefits of the plan to their advantage. I think this has been motivated by several factors. First of all, sponsors are ultimately more interested in keeping participants in plan longer. There seems to be a bit more paternalism where they want to help their participants not just get up to the point of retirement, but also managing completely through retirement. I think the individuals in the plan are also realizing the benefits that the plan offers. Things like fiduciary oversight and attractive costs are really important to them. And then lastly, and this sounds really simple, but just increased knowledge that individuals can stay in plan has been a big driver for this. We did a survey a few years ago and asked individuals about the idea of staying in plan, and they answered that one of their biggest hurdles was they didn't know they could. So now that more plan sponsors are more interested and they're advertising that to their participants, participants are taking advantage of it.
So Andrew, how has T. Rowe Price evolved to meet this mentality shift?
Yeah, so if you think about it, really what the shift has done is it's kind of extended the duration of the problem we're trying to solve. So ultimately, the investment horizon is increasing, and I think the relevance of the defined contribution plan and the overall savings plan for participants is increasing. And so what we're seeing is the need for participants to rely on those assets is increasing, and they're starting earlier, they're saving more. And so ultimately, it's kind of creating this longer term investment objective. And so with that, I think what we're seeing is, and the way we've been evolving is, we've been increasing kind of the growth assets in our glide path to kind of start to I would say to mitigate some of the risks that we're seeing with participant behaviors. And some of those behaviors are where we're seeing broadly that participants continue to undersave. And I think they continue to kind of underappreciate what those liabilities will be, especially as if you think about it, longevity and kind of the time that we expect to live in retirement increases. So if you think about it from kind of a balance sheet perspective, the assets aren't keeping pace with the liabilities. And so the participants really need these assets to work for them. And we've been reflecting that in our glide path.
So just to kind of wrap things up, for those decision makers considering target date options, what are the most important factors they should consider when choosing investment options? Wyatt?
Yeah. To me, the most important factor is setting the objective. It sounds complicated, but really all we're asking is, what are you trying to solve for? If you have an employee who's retiring at some point, what's the benefit you want to provide? And the way I think about this is, how much do you prioritize retirement spending versus how much do you prioritize reducing volatility around the retirement? These two goals tend to be at the bookends. Nobody is at either extreme. So ultimately, it's where you fall in between these. If you tend to fall towards the retirement income objective, long-term risks of inflation and longevity are probably more important, and you'll end up towards a glide path that leans towards growth. If you tilt towards the shorter term, you're focused more on downside, probably going to lean to a glide path that has a little bit less growth orientation. This goal-setting process is ultimately critical because without it, you can't be able to match the target date strategy to the actual needs of your plan.
And then Andrew, what do you think the most important factor is?
I think because there's no typical journey to retirement and not all plans are the same, not all the participants are the same, I think it's really important to find a partner who can grow and evolve with you, particularly with your outcomes in mind. And I think this is why it's particularly important to have a range of solutions, not try to fit all problems into a single solution, but really solutions designed to help address a variety of unique goals, whatever they may be.
We'll leave it there because that's all the time that we have. Many thanks to both Andrew and Wyatt. Really appreciate your insights.
Thank you.
Thank you.